Good morning. Welcome to Stock Market Today. This is Dan Russo, the Chief Market Strategist at Shaken Analytics. Hope everybody's having a great day. It is Wednesday, September 16th, 2020. Stock Market Today brought to you today and every day by Shaken Analytics. Head over to shakenanalytics.com/today. Sign up for a free email where we get a lot of the content for this show. We also hit you with daily stock ideas in your inbox every trading day before the market opens. So U.S. equities higher on Tuesday, though well off the best levels of the day. Comm services and REITs were the best performing sectors, while financials and energy were the worst. And that shouldn't come as a surprise to anybody who's been following me closely. Treasuries were mostly weaker with the curve steepening a bit. The dollar was weaker against the yen and sterling, better against the euro. Gold finished up 10 basis points. WTI crude up 2.7%, despite IEA cutting global demand forecast. So I think maybe the fall off in the price of oil was a little bit of discounting of that news, perhaps. Markets are forward looking. As we get to the desk this morning, futures are up 60 basis points ahead of the FOMC meeting, which is not expected to offer much in the way of incremental information. Asian markets were mixed overnight, with Australia and Taiwan the outperformers, while China lagged. European markets are stronger. Treasuries are unchanged. The dollar is weaker on the major crosses. Gold up 40 basis points. WTI crude up 2.3%. As we start the day with that counts. The S&P 500 closed above the 3,400 level. 3401 spot 20, that counts. Being a little bit facetious here, right? We're there. We're above the level. That's encouraging. But we're still dancing with it, if you will, right? We're doing the tango with the 3,400 level at the S&P 500. Resistance now, 3,500 to 3,600. That's unchanged from where it was, prior to the breakdown. Down below 3,250 is the level that's important if we're not able to, delicately walk this tightrope at 3,400. The Qs work higher from the 270 mark. I still like the risk reward here, even at 279 on the Qs. I think it's as a trade, if you're framing up risk reward and you just want to say, look, I just want some exposure, I'm looking for a trade, you have a 2-to-1 here, in my opinion. You have 300 to the upside on the Qs, 270 to the downside. So you have roughly 21 points of upside for 9 points of downside, a little better than 2-to-1 on the risk reward. If that works for you, take it. If you need a risk reward greater than that for your trades, you don't take it. It's pretty simple, right? If you require 5-to-1, then you're not taking this trade. If you require 2-to-1 or better, you're taking it, or you can. IWM rallies from $150. That's important. Strength here is a bullish breadth development in the near term. What does that mean? The more stocks that are moving higher, the more healthy the market. So we'd love to see the small caps get in gear. However, small is not leadership. It's an inline performer at best over the past 6 months, and bigger picture, it hasn't even eclipsed its February highs yet. Still struggling here at the June levels. So when we think in terms of leadership and where we want to be positioned in the marketplace, it's still large over small as far as I'm concerned. There are pockets of small that make sense. But it's an inline performer at best. And if your goal is to be an inline performer, then own small. If your goal is to be an outperformer, find what's outperforming. Let's hit our market in a minute now. What are we writing about in the note? Well, SPY retakes 340 and remains in an oversold position. That's encouraging. Qs and IWM extend from key support. We touched on all this already. Sentiment is still greedy, only less so. We have the FOMC meeting on tap today, not expecting much there. They've been pretty transparent over the past few weeks. Futures point to a higher open, as I said, once again today. So let's dive in to the power bars, the major indices. From a power bar perspective, not a ton changed yesterday, really. 8-2 bulls to bears for the Dow, which was flat. S&P 500 adds 50 basis points, 136 to 73 bulls to bears there. So still, solidly skewed in favor of the bulls. 3-to-1 bulls to bears on the NASDAQ. Take a look. Take a look at 1.42% yesterday. So there's your solid outperformance. Growth outperformed value yesterday. All was right with the world, at least for the day. Small caps underperformed. 646 to 290, bulls to bears. Bonds down tick, sending yields higher. Com services, your big group yesterday. Now we'll watch the group today. Some news overnight about Facebook and, obviously a big weight in the space. 6 to 2, bulls to bears there. According to the Chaikin Power Bar, small cap stocks and large cap stocks have become bullish. Major markets across the board are mixed. Let's hit our stock of the day. Stock of the day is PayPal. Okay. I've been running screens. I've been sharing them in my notes. Oversold tech stocks, oversold growth plays with this Qs holding 270. I've been running a lot of those screens looking for names like this, looking for names that are leadership, that are oversold within the context of their uptrend, but still kind of also, as thematically makes sense to me. As we'll look at a little bit later on, we're going to look at mobile payments. IPAY looks interesting to me, right? And especially as a theme coming out of COVID. But individual stocks. So Square was in the news yesterday, announced two new features that sent that stock higher. So I started paying attention to what was going on in mobile payment land yesterday. I mean, obviously I've been paying attention to it for a while. So saw the opportunity in PayPal. Now PayPal is actually interesting to me because I used to own it and, had to risk manage in here. And now I'm looking for opportunity. But I wanted to share it here first and in my note. PayPal is bullish. I do not currently own the stock. Bullish rating, strong trend above the rising long-term trend line, strong industry group. IT services, right, is where mobile payments fall. FinTech, if you will, is part of IT services. Kind of interesting. Is it financials? Is it technology? What is a Visa? What's MasterCard, right? A lot of morphing going on. So, kind of open your mind a little bit. Stocks been outperforming since January, oversold, bullish money flow. I mean, I love this setup. $180 looks like solid price-based support in the near term as well. I like the setup here. Is it guaranteed to work? No, but does probability dictate probably getting involved? Absolutely. Take a look at PayPal if you're looking for a bullish idea. Sector tracker now. Moving to the major sectors over the last 5 days. There's my materials at the top of the list. Tech getting back to the top of the list is encouraging. Obviously, when you're 20-something% of the S&P 500, we like to see you near the top of the list, right? Real estate, obviously, a small portion. It's kind of interesting. 2 days in a row, real estate is at the top of the performing sector list with things like comm services or tech. So kind of interesting. Industrials, the other cyclical group that we like. Discretionary healthcare, Utes, middle of the road. Comms, want to see them get going. Staples, defensive group near the bottom of the list. That's what you want to see if you're bullish, and financials and energy are the two cyclical groups we don't like, right? So it's not growth or value. You can own growth in an overweight, which I think makes sense, while also adding value/cyclical exposure, which I think makes sense. We've been talking about it for months, but you don't just add it blindly. Materials and industrials look much better in the cyclical landscape than do financials and energy. Do you want to be an inline performer or do you want to outperform? If you do the work, you can outperform. Let's hit our industry in focus now. Oil and gas, E&P. So yesterday we looked at services. Today we'll look at the E&P names, or at least the group, which, as you know, I'm not a fan of. Surprisingly, services look better than E&P in our model. Generally that gets flipped, but the group here, XOP, the ETF, has lagged the S&P 500 by 4.5% over the past 6 months. Has a weak ratio, 10 bears to 7 bulls in the quantitative model, ranked number 17 of 21 subsectors, having moved down 1 slot over the past week. So if you own names like Cabot, Valero, and Phillips 66, I think you have to ask yourself why. Now, it's interesting to me. I see a lot of people. I've had a lot of questions. I've had a lot of conversations with people. Hey, what do you think of these energy names? And I think it's interesting. And this is why I think it's interesting. And I think to the extent you have time on your hands, I think it makes sense to maybe do some reading up on these companies and figuring out which are the good ones and which are the absolute garbage. Because when the group turns, it's so under-owned that if you're ready, you could do really well as everybody else catches up, right? Think about materials, right? We were talking about materials 2 months ago. Nobody was talking about it. They started to work. Then people started to talk about it. Now you're getting paid. Same could happen in energy. I think if you have time on your hands, if you have some extra time and you want to do some reading up on companies in the space, I think that makes a ton of sense. But this group still looks awful. Right? There's no two ways about it. The trend is awful. I mean, it's not even back above the June highs. Bearish money flow, underperforming, bearish rating, kind of dancing with the trend line here. The group still looks awful. Like I said, if you have some time on your hands, take a look, drill down, do some work, right? Try to figure out why Carl Icahn loves Oxy, OXY, right? And then when these do turn, you could be in a good position to get paid. But I don't think you should own them now. Let's look at what's trending now. Alexion, some rumors that BIIB might invest. Corvo, positive comments at Morgan Stanley ahead of the Apple event. Oxy, speaking of, up 5%. AVY, SL Green, no company-specific news in those names. Carnival, equity distribution arrangement or agreement takes 10% out of that stock. Citi, some regulatory concerns about their risk management system. So their CEO announces that he's stepping down, and then we get regulatory concerns, things that make you go, LNC, I'm not implying anything there. It's just how my mind works. I spent 10 years covering hedge funds, so I am skeptical of much of what I read. LNC, no real news there. CFG presented at the BarCap conference. Some negative comments about NIM. And Norwegian Cruise, nothing specific there to drive that stock lower by 4%. Sentiment less greedy, but still extreme. Taking a look at the 13-day moving average of the CBOE equity put call ratio, we are still down near the levels that we saw back in the beginning of the year in January and February. Now we've alleviated a bit of the super. It's bizarre. We're going from super excess greed to just excess greed. I don't even know how to describe it. It's still in an excess position. VIX, after a spike, moving lower, but still hovering around that 25 mark. I think kind of, when the VIX is above 30, trading becomes a little bit more difficult. You have to reduce your position sizes, understand that movements are going to be somewhat more extreme. I think, if you're using volatility-based metrics to risk manage, right, your stops will widen out because of the increased volatility. So your position size should get smaller. You should risk less, right, such that any individual trade doesn't blow up your entire portfolio. We talk a lot about this with our clients on our calls. But, I guess the way it's sentiment, less greedy, but still extreme. That's kind of how I see it here, especially as it relates to the CBOE equity put call ratio. And with the VIX at 25, I mean, we're certainly not out of the woods just yet. These are things you need to pay attention to. Right? You don't just say to yourself, well, we retook 340. I'm going all in. No risk management. Buy them all. No. You look for your ideas, but you recognize that you still need a solid risk management process. At least that's how I view the world. Anything that I've bought in the past couple of days, I know exactly where I'm getting out. And if it triggers, we're gone. No questions asked. We have the FOMC meeting today. We'll see if that impacts rates in any way, shape, or form. 10 years kind of done a whole lot of nothing. Here's IEF, the fund, bumping along near the highs as the 10-year yield bumps along near the lows. The RSI is middle of the range. But I kind of wanted to feature it today just to bring it back onto the radar screen, considering we are going to hear from Chairman Powell later on this afternoon. And then finally, I said we're going to look at mobile payments. I think the chart looks compelling here. I think that you have potential here to retake, right? Similar to the S&P, retake on a rebound, never became oversold, holding bullish ranges. The scooter, which is a measure of relative strength in the StockCharts way of looking at the world, still 88, so still solid performer here. I think if you're looking for a thematic play, IPAY makes a ton of sense. You drill down on their holdings, find names like Square and PayPal as potential ideas. So that'll wrap us up for today. Take us for a 14-day test drive. Hope everybody has a great Wednesday. I will be back with you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.